Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Okay, I'll make a start. Well, it works. Should work. Should, right? Dangerous. No, it seems to be working. Okay, so today, today once again, bad voice. Too many cocktails. I don't drink, so what do I don't. To me, beer is disgusting, right? So, okay, so today we're going to do the last discounted cash flow lecture. So this is essentially where assignment number 1 finishes. It's also where the online quiz, or quiz test, whatever you want to call it, that you guys have, which is optional and redeemable after the mid-semester break, that will be done via Waddle. You don't have to go anywhere. This will become available to you, as you can see, towards the latter part of September. You will have the exam, or if you don't like an exam called quiz, it's not that scary. It's not a final exam or anything like that. It's nothing scary. And it's going to be based on, lecture number 1, maybe a few little concepts here and there, 2, 3, 4, and 5. And your assignment number 1, which is a discounted cash flow valuation of JB Hi-Fi, sort of finishes here. Next week in the lecture, I'll start talking about ratios, which is the other way to value companies. Very, very common way to value companies, including JB Hi-Fi. So that's really for assignment number 2. So assignment number 1 finishes here with this content, with this lecture, and the workshop as well. The workshop I changed around a little bit. So I'm going to be talking about the 2018 report for JB Hi-Fi, but it shouldn't go for more than 20 minutes, 25 minutes, the workshop. So please bring questions to the workshop and ask them once we finish that material. We should have about 30 minutes. And don't ask me after the workshop. Come to me privately. Ask in public. You can speak in public. It's not scary. Actually, it's the number 1 fear, right? Number 1 fear in the world, you're going to laugh, is public speaking. Death is number 2. I'm not making this up. This is true. They did a survey. Public speaking is the world's number 1 fear. Number 2 is death, right? So when somebody dies, you'd rather be in the coffin than speaking at the eulogy, right? Which is just crazy. But human beings are crazy people. So, Donald Trump's president, everything's crazy, right? So, the world doesn't make sense. So, that guy's so crazy. He's not qualified to work at ANU, let alone the White House. But, here we are. So today's lecture, and very importantly the workshop, I think is something you should definitely take seriously. The workshop, definitely attend and come prepared with a list of questions and speak up from the floor. I will not bite you. Your students will not bite you. You will not die if you speak publicly. I do it every day. It's maybe intimidating at first, but it's not that difficult. You have to give presentations in your life. Even if you're at uni, you have to give presentations, right? And if you're doing honors or masters or PhD with a thesis research component, you definitely have to do presentations. So it's not scary. You will not die, right? So come prepared, please. Today, however, we're going to finish off discounted cash flow and really complete the cash flow valuation approach. Shouldn't be too bad. I'll try to finish as soon as I can. Shouldn't be the whole 2 hours. Famous last words, but see how we go. So today, I'm going to be talking about cash flows a little bit, specifically discounted cash flow, which is what we use for the first assignment. It is the most widespread approach, the most widespread by far, of valuing companies. Estimating free cash flows, we'll call them. I already talked about what free cash flows are, but show you again. And discounting them at WACC to times 0. For KGW, does it for 15 years, right? If you open up a KGW model, let's say, example from, I don't know, week 2, week 3, yeah, week 2, for example. KGW does it for, after you enter in your historical data, KGW does it for 5 years in a very detailed way, as I talked about, I think, in lecture 2. And then for the next 10 years, it does the forecasting just using these phase 2 inputs here. So it does all the forecasting with, 6 or 7 key inputs like growth, like the margin, like NOPLAT, like taxes. And then for all the other years that are in the future, we use a perpetuity. KGW calls it, or the textbook calls it, as continuing value, perpetuity formula, value in perpetuity, whatever you want to call it, means the same thing. Usually it's cash flows after some specific period, in KGW's case 15 years, and 15 years is kind of the standard. It's not a rule, but most analysts that value companies sort of have 10 to 15 years, which they forecast growth and margin, depreciation, taxes, these sort of things. And then for all the other years that are so far into the future, we assume a company lives forever, remember. For all those cash flows, we use a perpetuity formula that we discount 2 times 0, and then add it all up. And that's done here in the valuation summary, as I'll show you in today's lecture. We've got 15 years of free cash flows discounted to the present value. So these are the free cash flows discounted to time 0 by multiplying them by a discount factor. Discount factor is just 1 over 1 plus r, or in our case 1 plus WACC to the power of n. And at year 1, this would be power of 1, power of 2, power of 3, power of 4, power of 5, power of 6, all the way to the year 15. And then for everything else, we use a continuing value or a perpetuity formula that we also discount to times 0. And add it all up, we get the value of the company. We'll talk about some few corrections that we have, such as the mid-year adjustment factor, all these things today, to eventually get to the enterprise value. So this number in KGW jumps here. We add any non-operating assets. We'll talk about those today to get the enterprise value. So this plus this gives you the total enterprise value of the company. Deduct any non-equity claims, which is usually debt is the biggest one. Not always, but usually, to get just the equity value. So enterprise minus debt and all these other items gives you the equity value. Divide by the number of shares to get the value per share. And then this number is what analysts report in their, well, they report a lot of other results, but that's the key result, the value per share assessment for whatever company they're valuing, which then you as the consumer, the investor, can see and then compare to the actual price, right? Price per share. Value per share, the analyst, or you as the analyst in JB Hi-Fi calculate, is compared to the price per share of JB Hi-Fi, which of course is very easy to look up. The price is not the problem, the value is the problem. That's why analysts are paid to generate the value. The price, they're not paid to generate the price. The price, any idiot can look up in 10 seconds. They don't get paid for that. You can do that yourself. The price is 26 and 12, 26 bucks and 12 cents. If you wanted to buy the company, one share in the company, you would actually have to pay a little bit more. Yeah, you would have to pay $26.13. If you wanted to sell the stock, $26.12 is what you would get for it. Yeah. Which in other words means the last trade in the stock was a sale. Yeah. You sell at the bid and you buy at the offer price. And the difference between the two is referred to as the bid-ask spread, also known as transaction cost. The price at which you sell and you buy is not the same. There are trading costs, right? The exchange does not work for free. Right? It's a company driven by profit. There are transaction costs that you will be charged as an investor in JB Hi-Fi or all other companies. You look up BHP. Actually, that's not the largest company anymore. I think Commonwealth Bank, maybe after the Royal Commission, they won't be, right? But as you can see, the bid and the ask is not the same. There are some transaction costs. It's not much, it's 1 cent. It's not crazy. It's not the 1980s when it was not 1 cent, it was like $1 per share. Crazy transaction costs. But still, they're not zero. So the value is what this discounted cash flow approach is all about. So we'll use DCF, as I said. It is the most widespread, by far, the most widespread. But it's not the only one. There are a few alternatives. So in assignment number 1, or any valuation question, what we're really interested in is net present value. NPV is something you've seen before. Even in 7006, in the introductory finance course, or whatever introductory finance course, wherever you did it, either here or somewhere in other university, it was about identifying the cash flows, discounting them to time zero, to value bonds, stocks, projects, whatever it is. All finance is, all valuation is based on that one fundamental principle, which is identify the cash flows and discount them all to zero. With a bond, the cash flows end, usually, because bonds have a maturity date, an end date. There are a few console or perpetual bonds. You don't see them anymore. Because they were issued in the 1800s, over 100 years ago. The British government issued a console bond. UK, I think a railway company issued a bond. The East India Trading Company issued a bond, perpetual bond once, but they're so rare that they basically don't exist. They have an end date, bonds, usually 10, 5, 30 years, something like that. So the cash flows end. With stocks, they don't end because we don't know when a company is going to go bankrupt. So we assume it has to live forever. Wrong assumption, but we don't have a better one. With projects, again, when you did projects in an introductory class, for example, usually the project ended 7 years, 10 years. The average life of a project in a company is 6 years. 6 and a bit, 6.2, I think, is the average of a project. Varies between industries and companies, of course, big differences. But the overall average is about 6 and change, 6.5 years, something like that. Right? And the approach is always the same. It doesn't matter. You're valuing a bond, a stock, a project. It does not matter. It's always NPV. Always. Always. Right? Always. So it's an NPV. Think of NPV as like a general term. And now what we're doing a discounted cash flow, which is a more specific term. It means the cash flows we identify are free cash flows. Right, we'll talk about those. And I've talked about them before, but I'll talk about them again. If you want the textbook definition, free cash flow is cash flow available for distribution to the providers of capital. There are two providers of capital only: external capital, debt and equity holders. They get all the cash flow, one way or the other. Usually debt holders get interest and the principal paid back. And of course, equity holders, that's how they get their return. So their interest, think of that as their return. Principal is their initial their lending, how much money they lent. They lent $100 or $100 billion, whatever you want for scale. And that interest payment that usually happens once a month, once a quarter, whatever the contract says, that's their return. Not always, but usually that's how it works. With shares, obviously shareholders are not paid a fixed return, a fixed interest rate. They are paid a dividend or a capital gains compensation, which means the stock price going up. So the dividends are not signed. It's not a contract. As I said before, if a company has a bad year, they can cut the dividend to zero, and the company can still, as long as it can pay its debt, it does not go bankrupt. With stocks, usually investors want a nice dividend, but they don't mind if they get all their benefit, their return in capital gains. For tax reasons, in Australia it does not matter because we've got dividend imputation. So if you get your return as a dividend or as a capital gains, stock price going up, it does not matter for tax reasons. In the US, you actually prefer capital gains for tax reasons. Dividends are taxed at the income rate, and capital gains are taxed at the capital gains rate, which is a little bit lower in the US. So that's why even some of these entrepreneurs, they have a salary of $1, and you're like, what the hell? Do they work for $1? That's crazy. They get paid in stock. They get paid in shares. And those shares are, they keep going up, hopefully is the idea. They're a good company. They keep generating a profit. and they get paid in stock or options, whatever the instrument is, and as eventually they have to sell it. At some point they sell it, and they have to pay tax on the gain, right, on what they bought it for and what they eventually sell for. All right, but free cash flow is overall number that gives us cash that is available to both providers of this external capital. Economic profit, I'll talk about on the next slide, is a method. It's a cash flow calculation that is used to also calculate an NPV, but a different approach, not NPV using DCF. What is it? Economic profit, if you like, is profit or cash flow in excess of what is required to meet the cost of capital. Right? Well, let's a little context to make it clearer. We're here. This is what we do in this class. We calculate the enterprise, or whatever you want to call it, discounted enterprise cash flows. The measure we calculate the cash flows that we need to discount to zero are these free cash flows, and we discount them at the WACC that I talked about last week. And this approach is the standard. It's the most widespread by far. It's best works for projects, business units, companies that manage their capital structure, which these days are most companies. Yeah? They really care about what proportion of debt and equity they have on the balance sheet. Yeah? JB Hi-Fi is one of those companies. If you read the annual statement, 2018, and the annual presentation, which I'll talk about in the workshop this week, the company clearly says, black and white, we manage our capital structure to this. Right? So we're using the right method is what I'm trying to say. You don't have to. There's no rule that says you have to use DCF. I've seen plenty of analysts, especially American analysts, use this alternative cash flow, which is the EP, the economic profit. So you still discount these cash flows at WACC. However, you do not calculate free cash flows. You calculate economic profit. What is it? Instead of free cash flow, which is NOPLAT plus depreciation minus CapEx minus change in working capital, economic profit is just NOPLAT minus the capital charge. What is the capital charge? It's the invested capital multiplied by the WACC. So in other words, this is the profit of the company, NOPLAT operating profit, and this is how much your external providers of capital charge you, how much you have to pay them in order for them to keep lending you money or not sell your shares, keep buying your shares. And the difference between the two, the reason why this is, you will sometimes want to look at this, is it explicitly shows you where the company is creating value. And then you would have a breakdown of NOPLAT and see what divisions, maybe for NOPLAT for each division, and which division is making money and paying, if you like, paying these external capital providers the most. KGW calculates this number for you in your model. So yes, we are focused on these free cash flows, and that's the calculation is done here in my lecture 2 example. But notice right next to it is the economic profit calculation. The overall operating value is identical. Identical. The cash flows obviously are not free cash flows here. They're these economic profit. To see where they are calculated, you can of course look at KGW, control side bracket to trace the calculation. What do we got here? Economic profit. Here's the discount factor. Here's the economic profit calculation. As you can see, it's NOPLAT minus this capital charge. NOPLAT is just coming from the income statement, the operating profit of the company. And capital charge, as I mentioned before, is the invested capital times the WACC. And again, in KGW, you can see, here is the invested capital, here is the WACC, multiply the two numbers, voila, you get your capital charge. Point is, you get the same number. There's no rule that says you have to use free cash flow. It's just a convention, right? But by far, the most widespread approach is, again, DCF. Again, there's more than just two. There's a third, and you probably see this in corporate. You've seen this in corporate finance. When I teach corporate finance, I do talk about the APV. So the adjusted present value method, when you discount a project or a company, when you're trying to value, your cash flow is still free cash flow, but your discount rate is no longer the WACC, because in the APV, you want to have the interest tax shield as a cash flow calculation, not as a percentage in your WACC. Remember, in our WACC, there's a section KD times 1 minus T times D over D plus E. In APV, that is not the case. In APV, the 1 minus T, if you like, is not a percentage. It's actually a cash flow figure, which is equal to the interest expense the company pays times the tax rate, which is the tax shield. And the shield is not in the WACC, so the discount rate obviously cannot be the WACC. It's actually the unlevered cost of equity, which is estimated via the same approach, similar approach, but it is not identical. You would use the APV when the company is changing a capital structure a lot, just to see the tax implications. That's when it sort of makes sense. KGW does not calculate the APV. It calculates these two, the first two. It does not calculate the APV. Do not calculate the APV for your assignment. I do not require you to do that. I will not require you to do that in any way, shape, or form, but it does exist. And still, just like these two first methods, it would theoretically give you the same stock price. It's just the discount rate is different, and the tax shield comes out of the WACC and is another cash flow in the that you're discounting to time zero. The capital cash flow method, I've never heard of it. I've never seen it used in practice. You can strike that out from the slide. Apparently it exists according to the textbook. I think the textbook dedicates like 1 page to it, and that's about right. I've never seen it used in practice. Maybe, I don't know, maybe 50 years ago it was popular, but not today. The last one, but yeah, so strike through it. That's not something I will ever examine or talk about. It's a waste of time. The last one I have seen in practice, this is used. Yeah, go ahead. Yep. I'm sorry? Louder? Oof. Oof. Let's try all the way to max. Mic. Let's go lapel up. Let's see if I can help you this way. So that's fine. This is maxed. Yes. Let's try this way. Let's go. I'm trying to help you. Maybe. Ooh. Yeah, maybe. I look like an idiot now, but at least it works. So this is not a Justin Timberlake concert. I can't sing anyway, so it can't be. But let's try it this way. So so those listening, I'm just playing with my microphone. Trying to accommodate the student, and it's a good request. It's important that I'll try it this way. Yeah, maybe. I don't know. Yeah, it's not easy. Public speaking is not easy, but not because of the microphone. Okay, let's try it this way. I look like an idiot, but that's fine. So the last method on this slide is actually important. You do need it. The place where you need it is when you value banks and insurance companies. The problem when you value banks and insurance companies is that they are highly levered businesses. They have so much debt on the balance sheet. They're 90% debt financed. How is that a problem? Well, let's have a look. I've got my example here from lecture 2. Let's go to the WACC. So in this company, 74% equity, 26% debt. The WACC is about 9 and change. If I'm a bank and my target weighting is mostly debt, so 10% equity, 90% debt, see that? That's tiny. The risk of the company is locked in the beta. You cannot have all this risk locked in the cost of debt. The credit risk can be very deceptive and can be very volatile. The riskiness of the business is locked in the beta. The credit risk is locked in the cost of debt in terms of the number. Cost of debt can change very quickly. It took 2 weeks to bankrupt Bear Stearns. It did. It's just 2 weeks. They had billions of dollars in cash on the balance sheet, and it was all gone in a week and a half. So you need some kind of a risk factor to reflect the industry, the riskiness of the industry. And that's what the beta is for. when you have such a disparity, when you have such a large proportion of the value of the financing coming from debt, that disappears, so to speak. And plus, if you have so much debt, you have such a huge discount as well when using EP, for example, or using adjusted present value at the APV method. So what I'm trying to tell you is when you value banks and insurance companies that have so much debt on their balance sheet, 90% of the financing comes from debt, which is rolled over, which is actually, it's very short-term debt, usually a week. So if you like, they have a lot of debt, it's not just one bond or short-term bill. They have thousands of bills rolling over every week. Usually there is a large rollover of debt every single night in what's known as the repo market, the repurchase obligation market. So if you like, every night there is a vote of confidence by the lenders of a bank or an insurance company to see if the company is solvent, which is why the confidence can disappear so quickly, which is why it only took 2 weeks to bankrupt Bear Stearns. Didn't take long at all. Bear Stearns was not a small bank. It was the smallest investment bank on Wall Street, that is true, public company, but still a massive company, much larger than Enron. And Enron took 3 years to go bankrupt after the mismanagement. Even longer, you could argue, 5 years. So what I'm trying to tell you is if you use a WACC as a discount rate for cash flows of a bank, you'll get a very high valuation, unrealistically high. You'll get a value of 20 and the current price is 10. Yeah, very high. So we cannot use, because of that discount rate, we cannot use, and so much debt on the balance sheet, we cannot use the enterprise DCF method for banks. The alternative is we just look at the equity. That's it. That's all we do. So in the equity cash flow approach, the cash flow that we need to discount is really dividends that the bank pays plus any changes in equity capital. And like it says there, the changes in equity capital are issues of obviously the change. If there's an increase in equity capital, there's a share issue. If there's a reduction in equity capital, that's a buyback of shares that the companies do. And you need to clearly, as an analyst, estimate. You actually need to predict how much the company is going to raise in a new issue of shares, how much they're going to buy back. The discount rate is also not the WACC. It is the levered cost of equity, which is just from corporate finance. You should remember is the levered cost of equity is equal to the unlevered plus the spread between the unlevered and the cost of debt times Y minus tax, the tax rate, times the debt to equity ratio. Not examinable. I won't ask you questions on that in the mid-sem, or it's not a mid-sem, it's an online test, or the final. But if you're valuing a bank or an insurance company, which we're not, then we cannot use DCF. We have to use the equity cash flow method. So in this table, enterprise value used probably 80% of the time. Economic profit maybe 10. APV, you see from now and then, I would say a couple of percent. And for banks and insurance companies, the equity cash flow method is used. Again, capital cash flow I've never seen ever used. I didn't even know it existed before I read the textbook. Yeah. So these are all MPV methods. They're all MPV methods. They all can be used to value, other than the last one, they can all be used to value JB Hi-Fi. We're using the most popular one, Enterprise DCF. But it doesn't matter what you use. Like the example from Lecture 2 shows you, EP, APV, DCF, you would get the same value. Right, notice the huge jump in value because I decreased the WACC. Right, it was like that before. It was 1.7. I pumped up the amount of debt on the balance sheet. 1.7, now 3.5, right? So billion. So big difference, right? So that's why when you use this sort of approach in a bank, you'll get such a large operating value for a bank or an insurance company. Banks are they're good businesses, especially in Australia. Who can tell me why? It's a good question, actually. It's an interview question. It is. I've been asked that. Yes, that's their business, but why? Okay, let me ask you this way. I framed the question incorrectly. during the 2008 crisis, 2009, people were talking about the death of banks, the death of the banking model. The banks were going to disappear, right? Why was that a complete lie? Why will banks never disappear? What is that one thing that banks do that no other entities do that essentially guarantees that banks will always exist? Always. Correct. They allow you, so the lady's correct, bank is the only institution that allows you to unlock future income. It corrects a market failure. That's the reason. So economics people talk about a market failure. What we have here is me. I cannot draw, by the way. That's the best I can do. Right? That's it. It ends there. And I don't want to be homeless. I want to live in a house. I need a roof over my head, like all of us in this room. I don't have a rich family. I don't have rich parents. How can I get this roof, given I don't have $500,000 or $1 million in my bank account, and I don't have anybody to give me any money? What I can do is I can go to a bank. I don't know how to draw a bank. Let's draw a vault. That's not a vault, but let's go with it. I can go to a bank and say, I will give up my income, my after-tax income, for 10 years, 20 years, whatever, 30 years is the standard mortgage rate. And for that, they will give me a huge bunch of money at time zero so I can buy a house, so I can have a roof over my head. In other words, they allow me to unlock used income I have not earned yet. They allowed me to use income I don't have to wait 10, 5, 30 years for. There's no other institution other than the mafia or some unregulated online garbage that you should not be using that does that. Nobody will give you cash today for income you have not earned. Banks, so what I'm trying to say, the market failure comes into this. I have the ability to earn income, but I haven't done it yet. So that income that I need to buy a house, it's in the future, but obviously I cannot travel into the future or anything like that. So it's a market failure. I have the potential to earn the money I need to buy the house, just not today. I still have to wait. So it's a market failure. I have the potential, but because it hasn't happened yet, I cannot buy that house. A bank steps into this market failure and says, okay, sacrifice your future income for 10, 15, 20, 30 years, and we'll give you that money, plus interest, of course. They want a return on their investment. And we'll give you that money to buy that house today, unlocking that future income. They correct the market failure. The market no longer fails. I can actually use money I do not currently have to buy a house. And for that, they get the money back plus a return. Yeah. And that's why there's no other entity that does that. Governments don't do that. They used to, a long time ago. In the 1800s, there was no commercial or investment banks. It was just government banks. But maybe in the developing world, it's still the government. But even if it's government-owned bank, it's still a bank, a private company that may be partly owned by the government, but still operates like a company. There's no alternative to that. Yeah, so that's why banks, as much as we hate them all, they're greedy, blah, 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 big fees, they will never fail because you cannot have a homeless population. So with banks, we cannot use a DCF. But with the JB Hi-Fi, we certainly can. But the objective doesn't matter. This slide sort of tries to tell you that it doesn't matter what method you use, it's always the same approach. Estimate future cash flows that belong to the providers of capital. Remember, the providers of capital provide the company with external capital it needs to grow, usually. And then once those cash flows are identified, in our case, free cash flows, we discount them to time zero. In order to do that, we obviously have to identify these cash flows, and that's the hard part. We have to predict the future. we have to estimate the performance of the company in the future, and that is not easy. Forecasting the future is not easy. And the word sounds sexy, forecasting, right? First time I heard it, I was like, wow, I can actually tell the future. No, I can't tell the future. I can make a reasonable guess, but that's all. And I'm going to be wrong. I just don't want to be very wrong. Right? And then once we forecasted these cash flows, usually this is not hard. The cost of capital estimation, like I talked about last week, it's not that crazy, subjective. Yes, there's variation, but one team in this course for JB Hi-Fi might have a WACC of 6, another team 6.2, 6.3, 5.3, whatever it is, because the methods and what we're using as the CAPM inputs, risk-free rate, the beta, the ERP, the cost of debt, as long as the company is stable and the economy in which the company operates in, majority, well, it's not a just Australian company, but it's mainly an Australian company, is quite stable, the WACC will be stable. So the cost of capital is generally, for an analyst, not too difficult to use and estimate. The hard part is the forecasting of those cash flows. And that's not easy. That's why you as an analyst get paid $120,000 starting salary as a graduate, right? Because those forecasting of those cash flows is not easy. Doesn't matter which approach you use, DCF, EP, APV. You just take a different perspective. The overall value is still the same. So do you value just the total enterprise like you do with the DCF or the EP, or do you value just what the equity holders are, what their shares are worth, which is the equity cash flow method? Do you use the shield, the interest tax shield? Do you have it as a percentage or as a cash flow, right? In other words, do you use a WACC where the tax shield is as a percentage, or do you use something else, or do you use do you have the interest tax shield as a cash flow, so you don't have it in the discount rate, which means you use the unlevered or the levered cost of equity? Do you use a static capital structure or a variable capital structure? There's no rule that says the WACC that you estimate, even for JB Hi-Fi, has to stay the same. KGW gives you the flexibility. I think I've showed you this before. Let's say you estimate your WACC here in this example, whatever it was originally, 9.74. When you go through the forecast drivers, that number goes here. And you need that number for all your years that you're discounting. There's no rule that says that number has to be static, like I said in previous lectures. And you as an analyst can make a prediction of how it's going to change. With JB Hi-Fi, I mean, it might change if they do another acquisition. The Good Guys acquisition was not small. It was a big acquisition, so the capital structure changed, but we cannot predict what they're going to do. The company will not tell you, we're going to buy Harvey Norman. The moment the company tells you we plan to buy Harvey Norman, guess what happens to the Harvey Norman share price? It goes up 30%, and then the deal becomes 30% more expensive. Companies do not announce deals before they happen, because that makes everything more expensive for them, 30% more on average, because that's the premium you have to pay for control. So the companies will not tell you. As an analyst, when I had a change in WACC, usually it was because the cost of debt was too high or too low, or the risk-free rate was too high or too low, and I expected the Reserve Bank in Australia here to step in and lower the risk-free rate or increase the risk-free rate when they're trying to fight inflation. In this course, don't do that. It's not worth it. But if you wanted a varying WACC, the only thing that makes sense to me is forecast the risk-free rate going up. Doesn't sound like my voice. It's too nice. My voice is too deep. So, yeah. So you can have a varying WACC. And if you want a varying WACC, let's consider that. You don't need to do this for your assignment, but what would change? The risk-free could change, yes. Beta, not really. The ERP, not really. Tax rate, not really. Cost of debt, it's already AAA rated, or synthetically the coverage ratio, like I mentioned in the workshop, is very high. I mentioned it in the workshop. So the only thing that you as an analyst or as a team, if you want to have a changing WACC, the only thing you can play around with is a risk-free rate that should go up, the 10-year rate, because currently 2.9%, that is very low. Historically, it's been around 4 or 5%. I don't think it will go up to what it was when I was in your position in this course, which was 6 point something, 7%. But it will grow from 2.9. It should be to like 3, 4, and then the question is how quickly does it go? It would go very slowly to that sort of 4 or 5% figure. But again, it's objective. So we don't need to do that in this course. We don't need to play games with the WACC. Just have a static WACC, but there's no rule against it, against having a variable WACC. In theory, like I said, all these approaches, whether APV, EP, DCF that we're using, should give you the same number. I mean, KGW will show you the valuation for 2 methods. In the valuation summary tab, it will show you the method for the DCF, which is what we're using, but also the EP, and these 2 numbers should be the same. And they all should roughly give you the same value for the company. But in practice, sometimes, yeah, there is some variation. There is a little change because you sort of scrutinize and you focus on different things. But not really a concern for us. Okay, so let's talk about this DCF. Any questions, thoughts, queries, or concerns? Yep. Yeah, that will never be an issue. Again, equity, there's no requirement to pay shareholders anything. You just cut the dividend to 0. You can see the stock price go down. I mean, we can have a look here. Google Finance. Let's pick a juicy bank. Let's go for the most famous of them all, the vampire squid, Goldman Sachs. What do we have here? 2008, bingo, boo, right? And do we have dividends? There was dividends here. I think it's Yahoo Finance gives dividends. Let's go Yahoo Finance. I don't want the Australian, but sure, Goldman. It's an NYSE stock. There's the one. Okay, do we have dividends? Do they give dividends? Ooh. So let's go full screen. There's dividends here, the D. Let's try to go back 5 years. Let's try to go maximum. Yeah. See, they sort of had a dividend in October. And as you can see, there was they kept paying dividends even through the financial crisis. So not an issue there, but there was no requirement to do that. As you can see, the stock price took a huge hit. So to answer your question, and all the banks did, to answer your question, there is no, if the banks don't pay a cash flow to a dividend to the shareholders, that's fine. No bankruptcy. And if their stock price keeps going down, again, it's just, they don't go bankrupt. There is no requirement for your stock price to keep going up or be a certain level. So Goldman, do we have another one that I can think of that was in trouble? Bank of America, no. Morgan Stanley was the next in the list. Morgan Stanley. APF, that doesn't sound right. MS, that sounds right. See if they paid a div. Next. So no, they kept paying a dividend. As you can see, they cut it a lot. They cut it to like 5 cents a share there from, 26, 27, high dividends. They cut it all the way to 5 cents a share. Again, it's no requirement. They can cut it to whatever. They can cut it to 0. Yeah. So in that valuation method, They actually did a lot of share issues as well. So if you do using that valuation method that you're asking me about, there was a lot of share issues. So this equity capital kept growing and growing. So ideally the company was, worth more and more, but market value it wasn't, because all the stock prices were going down and people were shorting and selling stocks very, very quickly in that those 2 weeks in 2008. As a shareholder, you would have lost 70% of your value. Right? So, but yeah, it's not a requirement. With dividends, that's the one benefit of shares, I guess, gives you more flexibility. You as the board of directors selects the dividend policy of the company, and if your management team tells you, we cannot pay a dividend or we'll go broke, cut the dividend to zero. You don't have that benefit with debt. You don't pay your bills, you don't pay your interest expense, you close. Any other questions? Yep. The credit rating in the cost of debt, yeah, that's correct. Remember, like I talked about last week, where's lecture 4? So what I was talking there when I say that, what that means is when you start estimating cost of debt for these businesses, I'm really talking about this approach. And the weaker the credit rating, the higher this number. So the higher the cost of debt. As you go down in credit rating worthiness or credit rating, obviously the interest rate starts going up very quickly. So a lot of the banks during the financial crisis had huge reductions in their credit worthiness. So much so the government had to step in. Government had to step in and be the lender of last resorts. So essentially the US government, the most liberal government in the world, ideally, was nationalizing private companies. It was bailing out the banks. Without government stepping in and bailing out AIG, all the banks would go down, would collapse. Yeah, because AIG was writing the insurance on all those credit default swaps, all those CDOs. So the insurance was called a credit default swap. The default swaps, so when the bond goes down, fails, the insurance company AIG pays all the banks. And if your insurance company goes bankrupt, guess what is the value of your insurance contract? Yeah, zero. It's worthless. Yeah. So to answer your question, yeah, it's based. The cost of debt goes up. The cost of debt goes up as your credit rating goes down. Yeah. And the worse your credit rating, again, I don't believe in credit ratings. I prefer to calculate the interest coverage ratio myself because it doesn't lie. And credit ratings, we talked about it last week. There's a huge conflict of interest there. But we don't have an alternative. The only alternative I've heard of, I talked about in class last week, that those credit ratings from the Singaporean University. I think NUS, National University of Singapore, created a formula, very simple formula, that allows you to calculate credit ratings. Yeah. Mm-hmm. Okay. So back to this lecture. So we're focusing on DCF. That's what we're doing. That's the standard. That's most popular by far. The theory is not complicated. This is how it works. We, as analysts, have to estimate these free cash flows. Remember, free cash flow is just NOPLAT plus depreciation minus CapEx minus the change in net working capital. And net working capital is just cash, operating cash, not total cash, operating cash, inventory, accounts receivable, accounts payable. Operating cash plus inventory plus accounts receivable minus accounts payable will give you the free cash, the working capital, and change of that working capital from year to year is included in the free cash flow calculation. That calculation, that's why these are important in KGW. Right? The model does all these calculations for you, but you have to say what happens to the working capital, obviously, and that all that action happens here. There's right after forecasting the growth of sales, the working capital section starts, and you've got, as you can see, all the working capital, WC. Operating cash, inventory, accounts receivable, accounts payable. OCA, OCL, other current assets, other current liabilities, usually very small, as you can see, tiny for this example. But sometimes when you don't know quite how to classify something, in this case the team didn't, didn't really fit into cash inventory, receivable or payable. They put it in OCA, OCL. That's really going from the historical data. As you can see, nothing to forecast here, but these are the key items for working capital. In the exam, you will need to, I will ask you how to calculate free cash flows. You 100% guaranteed, right? If you go to the past exam question whatever 2 or 3 will be that, right? Guaranteed. Is that selected questions? Yes. So question number 1, what's NOPLAT? Question number 2, what's free cash flows? Guaranteed, right? Question number 1, what's NOPLAT? Question number 2, what's free cash flow? I'll ask the same questions in the online test, same questions in the final. Question number 1 will force you to calculate, will ask you to calculate NOPLAT for a company. Question number 2 will ask you to calculate free cash flows. Guaranteed. I'm telling you the questions. See how nice I am? So nice. So this is important, right? The free cash flow is what you need to value the company. That's what we're discounting to times 0 at WACC. After we do the discounting, we get this enterprise value, right? For the 15 years and then the perpetuity, all of that added together is the enterprise value. Then this enterprise value gets split between shareholders and debt holders. The debt holders get their after-tax interest payments and their principal back. The debt value, that action happens here. So the debt value here is, that's why it's subtracted in KGW, where is it? Over here, they get their debt and their interest they get over time. That goes through the income statement. Remember, now you're working with this. It goes through the income statement, but in the forecasting, it happens down here. Interest, here it is. No, that's leases. Here is the interest. Retirement. So there's interest on any non-operating expenses. Here it is. Here is the interest expense. This is where it's calculated. You need to put in these rates for your assignment. Right? The long-term debt 1, long-term debt 2, that should be the cost of debt in your WACC. From your WACC, those are the same numbers that you estimate cost of debt for JB Hi-Fi. Those two should be the same. This one, these two can be blank. You don't have to. This one generally is 1% less than the long term, just based on the slope of the yield curve in Australia, which is inverted, which is a good thing. This one, you can just, if you want to enter a number in there, you can just think the term deposit rate or some, what you get on a saving account in Australia, which is generally 1.5%. So if you have a bank account with NAB or Westpac or whatever, you have it in a saving account, a transaction account, but it's saving in nature, you'll get about 1.5% per year. So you can put 1.5 there. Your cost of debt for long-term debt 1, long-term debt 2, and for balancing a short-term 1% minus the cost of debt for JB Hi-Fi. So that's where you enter in your interest. So your debt, the principal that the company borrowed, is subtracted in the valuation summary tab, and the interest just flows through the income statement in your KGW model. But what you're left with after those is you get what the equity holders get, which is a dividend, and the equity value. The equity value is what we're interested in as analysts. We take this value, divide by the number of shares to get the value per share, which is the number we're obsessed with. That's what we want. Because we need that value per share compared to the price per share for whatever company we're evaluating. You've seen this before. Any questions on this? It's important. It looks simple, but you have to have it clear in your picture how the company generates cash, generates a profit. That profit is turned into free cash flows. That free cash flow is used to capitalize the value of the company, i.e. turn this stream, this series of free cash flows into a total enterprise value, which gets split between the two external providers of capital. That's how it works. That has to be clear in your head. If you don't find it clear in your head, think of it this way. A house. Think something very, very simple. you have a house. The house generates rent here each year to get, if you can use that rent forecast forever, or 30 years or 50 years, 100 years, whatever. The life of the house is about 70 years. So you have a rent for 70 years. Discount all the time zero to get the value of the house. And then let's say you and your brother went in to buy a house. He gets this part of the rent, you get the other part. Or if you borrowed money from a bank, the bank gets this part and you get the rest. And we're interested in that risk, that what that equity, me as the owner of the house and bank as sort of the co-financer of the house gets, they get how much they lend me and interest, I get the rest. Same thing, same idea. Any questions on that? It's important that that's clear. Yep. Yes, that's just, it's based on the slope of the yield curve. I don't have time to discuss it, but it's important. So in Australia, we have an inverted yield curve, which means if you plot the yields of bonds, you would have yield here as a percentage and time here. It would look something like this. So this time would be, this is the 1-year yield, this one. This would be the 5-year yield, this one. This would be the 10-year yield, this one. The difference between these two, between long and short term for a company these days, because interest rates are so low, is only about 1%. So short term means 1 year or less. Long term sort of means 5 years is our perspective, or 10, 5, 10, something like that. Difference between that is about 1% in Australia. Every country is different. They have a different yield curve. If you're in Japan, right, this yield curve looks something like that, right? Our yield curve in Australia, which is just a 2-dimensional plot of the yield here on the y-axis and time in years on the x-axis, looks something like that. And the difference between the two is that difference that I'm talking about, 1% roughly. So 1%, just use that. That's actually what it is. Any other questions? Okay, so after we have this division, separation between debt and equity value, we're good to go. Our valuation finishes. But of course, the difficulty, as you can see, this calculation is not difficult. You're just separating cash flow into 2 parts. It's not rocket science. The difficulty, of course, is coming up with these 3 cash flows which are forecast. So in a DCF, you've seen this before. I've talked about it again. Again, the steps are not complicated. There are 6 steps. That's it. Estimate the NPV of cash flows from operations. Remember, from current operations, we don't go into the what-ifs. This is not sci-fi. Valuation is not science fiction. We don't value JB Hi-Fi. What if they acquire Harvey Norman? What if they go into Europe? What if they go all online? What if they close all these stores? We don't do the what-ifs, right? That's science fiction. We value current operations. The company might do that, but they'll never tell you ahead of time. We only can use the information that is current. We do not guess about what the company might do 3 years from now or whatever, right? So we estimate, we calculate the cash flows of current operations, discounting them at WACC. To your model, and this is standard, separates these cash flows into 2 parts. Cash flows are specifically estimated for the first 15 years, and then we use a perpetuity formula or a continuing value formula, whatever you want to call it, for all the cash flows after 15 years. Remember, we assume companies live forever, so that they go until infinity. After we have those 2, those are the value of operations, which is what the main value of any company. There might be other non-operating assets, could be some land they bought they don't use, could be a lot of DTA, deferred tax assets, are a non-operating asset. If we have the market value, we take the market value. Generally, we don't. We just have the book value, so we take the book value. The total value, this enterprise value, in this slide, is just the sum of all the operating value and the non-operating value. Then step 4 here, we have to do the separation between debt and equity holders. So we subtract all the value that it belongs to the debt holders. Usually it's debt, not just debt. It could be preference shareholders as well. Options. JB Hi-Fi does not have preference shareholders. After we subtract all the debt, the non-equity, other non-equity claims, we get the equity value. And last step is take the equity value, divide by the number of shares. And that's it. The procedure is not complicated. You're just adding, subtracting, dividing numbers. The hard part is that, cash flow, forecasting. Everything else is quite standard. Here are the steps from lecture 1. So this is what I talked about in lecture 1. The steps when I was talking about what value is and what we're going to do in this class is identical. This is the example I used in lecture 1 as well. All these steps, you start at the revenue, go all the way to NOPLAT, go to free cash flow, discount free cash flow, all the way to time 0 to get eventually value per share. KGW does this for you in the online test and the final. You will have to do that, but obviously I'll give you an example that's a lot more simple. As you can see in the example that I have on, I don't have it up anymore, on Wordle, the past example, it's not some complicated company like JB Hi-Fi, right? Obviously, you only have a limited time to write the exam, so I give you a very small fictitious company, right? It's very short income statement, very short balance sheet. But the steps that you're doing are these. And I give you the forecast, obviously. No, I ask you to calculate the score. Okay. So KGW does it in the valuation summary. So let's take a look at it. So all these calculations, this turning these free cash flows into enterprise value, dividing, it's all done here for you in the valuation summary tab. As I said again, I'm not going to waste time repeating myself. Free cash flows discounted to 0 gives you the present value. Add it all up. We'll talk about these adjustments. We'll talk about this formula in a sec to get the operating value. That operating value goes here, and it's also the same as the operating value using the EP method. Operating value plus any non-operating assets. In this example, it's a joint venture and some financial investment, maybe stocks in other companies. Non-operating assets clearly gives you the enterprise value. Right, that's this. Then KGW divides the enterprise value by into the debt section or the liability section that's here. After it subtracts all those non-equity claims, usually debt is the largest, you're just left with equity value. You're just left with the equity value here. And then you divide by the number of fully paid ordinary shares to get the value per share. And that's the number then you compare to the price. You don't have to do this. I don't require to write you a report, and you're not required to write a report anymore. But as an analyst, that's what you do. You calculate the value per share and you compare it to the price per share for that company, for that stock. So that's what's happening here in the slide. This is from the textbook. We've got some forecasting years. For each year, we calculate free cash flow. We discount at the time 0 using the discount factors. Remember, the discount factor is just 1 over 1 plus WACC to the power of n. N is 1, n is 2 here, 3 here, 4 here. Multiply the two numbers, you'll get the present value. For all these years, what are 10 years? Less than that. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 years. After the 10 years, you have a continuing value formula for all the cash flows that come after the 10 years. Discount at the time 0. Add all those up, you get the total operating value of the company. Notice this number is massive. It should be massive because it's all the cash flows that come after year 10. More on that later in the class. Then we've got this mid-year adjustment factor. Again, bear with me a few more minutes and I'll talk about it. It's actually the last slide of this lecture. To give you a total operating value of the company. add any non-operating asset. In this example, it's some long-term investment and DTA, deferred tax assets. Gives you the total value of the enterprise value here. Subtract the debt, subtract any capitalized operating leases. If they're capitalized, they're treated like debt. So JB Hi-Fi, there will be capitalized operating leases here as a debt deduction. To get the equity value, divide the equity value by the number of shares, you get a share price. The model I have that I've talked about a few times, that's very basic, if you like, the most basic DCF model I could come up with that still works is this bare bones that I've showed you before. It does the same thing. All those steps, all these 6 steps or 5 steps, however you summarize it. KGW does all those other than it stops here because that's where the hard part is, this forecasting. And then the rest you can complete yourself. So you can actually use, and I advise you to do it as a check for JB Hi-Fi for your company. Use the bare bones model to value your company, to value JB Hi-Fi. So you have your sales growth for 5 years, and then you have some kind of a terminal. This is the continuing value long-term growth. Could be 5 years, could be something, depends on your company, of course. Sales at T+1 divided by invested capital at time T. This is your efficiency ratio. Talked about that before. And you put in your NOPLAT margin, not your EBITDA or EBIT margin, your NOPLAT margin. And then all you have to do is enter in your invested capital here, the start at time 0, your current invested capital, so to speak. And then you put in your WACC. Everything else is calculation, as you can see. It will all calculate things for you, and it will give you an enterprise value for JB Hi-Fi or whatever company you're valuing. From here, to go to equity value is actually quite easy. You already know that how. You just have to add the non-operating assets, subtract all the debt, divide by the number of shares, and you get a share price. So I encourage you to use this model as well for JB Hi-Fi. But remember, it stops at enterprise value, so you have to take it further and calculate the equity value. But that's easy. Just dividing and subtracting a few numbers. It's not complicated. What I'm trying to tell you, hopefully I've achieved that, is that the calculation itself, it's always the same. And that's not complicated. It should not be somewhere where you make a mistake. Okay, so let's talk about these free cash flows. So the steps are complicated. What about these free cash flows? What are free cash flows? Like I said in the beginning lecture, free cash flow is just NOPLAT plus non-cash items, which is basically depreciation, amortization, right? The D&DA. Minus any investments, invested capital, and that is capital expenditure and change in net working capital. Alternative, if you want a textbook definition, free cash flow is the after-tax cash flow available to the 2 external providers of capital, 2 external investors in the business. It excludes any non-operating cash flows. They're valued separately. Remember, they're valued separately. Usually we don't have market values for them, so we just use book values for the non-operating assets, which is not good, but if we don't have data, we can't just make it up. So book value is usually good enough. And they're typically small as well. Non-operating assets are usually very small. I mean, for Tesla, I think the gentleman was asking a question about last week. Tesla DTA will be large, right? Because they have been operating at a loss for a long time. So for that, but for JB Hi-Fi, that won't be the case. The non-operating assets will be quite small. How do we calculate free cash flows? Well, the accountant's cash flow, we can do it from the cash flow statement. The accountant cash flow statement looks something like this. You have 3 sections to the cash flow statement, if you remember to your accounting class. You have cash flows from operations, cash flows from investing, cash flows from financing. That's nice, but that's free cash flow is not anywhere in this cash flow statement. We as analysts have to calculate it ourselves. So we have to go from NOPLAT, we have to calculate NOPLAT, add any non-cash items, which in this case is just depreciation, but amortization as well, if it's not 0. That will give us something called gross cash flows. I don't like that term, I don't use it, but yeah, that's what it's called actually. Now you have to subtract all your capital expenditure, which is usually your reinvestment in the business, replacing depreciated machinery, that sort of stuff. And then you have to, here we have net working capital. Here we've got two changes. One is inventory, and one is accounts payable. Inventory is an asset, remember. The less we have of an asset, so if inventory increases, like in this example, increases by 25, that means we had to invest in it. We had to lock that money away in inventory, and the inventory is now sitting in a warehouse somewhere, for example. Well, that's money that we don't have. That's money that's locked away in inventory for JB Hi-Fi, TVs or something like that, that we didn't sell at the end of the financial year. And if that's going out, that means you paid, that's an additional cash flow that your debt and equity holders will not receive. So that's a subtraction. When assets, and by assets I mean operating cash, inventory, and accounts receivable go up, this is negative. It's a deduction in the free cash flow calculation. When a liability, there's only one liability, and that's accounts payable. When that goes up, if you like in this example, goes up by 25, this is a positive cash flow. The reason is that you were able to pay on credit more, and there's no payment of interest for accounts payable. Ideally, you want to use accounts payable as much as possible as a company. And you want to have the longest terms. You want to have 90 days is sort of the standard, 180, not anymore. It used to be maybe 40 years ago. But now everybody wants money sooner. Now what's become standard is 30 days. Accounts payable has the terms of trade means that you have to pay for whatever you buy in 30 days as a company. You can be 90. But the longer it is, the better, because you get the goods straight away, and you don't have to pay for 90 days. That's good. So anytime the liability goes up, like in this example, it's a positive, it's an increase in free cash flow. Right? So what do we go here? No flat plus depreciation. These two cancel out, but minus 25 for the inventory increase, a plus 25 for the increase in accounts payable, minus the capex will give you a free cash flow of 160. You don't have to worry about the rent. So 160 is what this cash flow is that we would be discounting at WACC to value this company for that year, obviously, that 1 year. We do this for 15 years, and then the continuing value formula, obviously. Any questions on that? I'm sorry? Speak loudly. I'm going at my max. Come closer. I don't bite. The volume's max. Oh, I see. Yeah, you should have said something sooner. So those listening, sorry, the microphone fell. You should have attended class, right? It's your fault. Okay, so let's start again. This mic is horrible. So let's try it now. Okay, so here we go. So for those rejoining us listening, sorry, the microphone fell, but we're here, we're talking about free cash flows, and you need to know how to calculate this stuff. By the way, and I don't have time to repeat it, so good luck. Attend class, right? Okay, so here we go. So free cash flows, after we have that, we have to talk about all these cash flows that come after the 15 years in KGW's case. What we use there is a perpetuity formula. Perpetuity formula is something you've seen before. It's not complicated. Right? Probably seen this before. Perpetuity formula is you've either seen this, or maybe you've seen this, or maybe you've seen this. They're all the perpetuity formula. They're all the same. They're a way of discounting, calculating the present value of an infinite series. Either it's a static series or it's a geometric series. That's what we need for continuing value. Okay. So, going back to our slides here, it's an estimate of operations beyond the 15 years in the case of KGW. Because you're using you're collapsing everything into a perpetuity, the company should really be at steady state. Not all companies are at steady state at 15 years, I understand. If as an analyst you would be valuing a company that has not sort of reached maturity or steady state, whatever you think when you think that term, just think of stable cash flows and operations of the company. You generally have to increase that 15 years to 20, 25, even 30 years I've seen, before you can use this continuing value formula. So the 15 years is not a rule, it's just a benchmark. And if you're valuing a company that takes longer than 15 years to get to steady state, you have to increase this this part A, 1A free cash flows, not 15 years as your horizon, maybe 20, 25, something like that. Because when you turn from the cash flows into a perpetuity in here in 1B, the company should be at steady state or very close to it. It should be mature. Right. So by steady state, what does that mean? That means the margins, no plat margin, the asset turn, which is that efficiency ratio I talked about, sales versus invested capital. ROIC should all be at sustainable levels. And all companies mature. Don't get me, so even if the most innovative companies, even Tesla, will mature, right? So there's no such thing as infinite growth. It doesn't exist. So you want to, when you start using this continued value formula, you want those to be stable. And by stable doesn't mean flat, doesn't mean all the same forever. It means not changing much. So the variation should be small. And that doesn't mean zero, just something reasonable. No plat, free cash flows, and growth rates, all at maintainable, and analysts call that trend levels. Trend, think average, if you don't like the word trend. And the reason why they all have to be at steady state, whatever you think that might mean, is because, as you see in my previous slides, this free cash, this continuing value can be huge. Even without at the present value, it's huge, 41 here, 41 billion. Without the discounting, it's 92. That's a huge number. You don't want for this number to be so artificially high that you overvalue the company. And analysts, and I've seen analysts who are trying to manipulate or trying to get a certain valuation, do play games with that continuing value estimation. They do artificially say, oh, the company's going to grow at 5% forever. Yeah, sure. No company can grow at 5% forever. It can't. I remember 10 years ago, everybody saying, oh, China's going to grow at 9% forever. It's interesting. To my knowledge, it's not growing at 9% anymore. Right? It's lucky to get 6 or 5. And that's going to go down even further. Right? So nothing grows forever. So if you start manipulating your continuing value assumptions, and plenty of analysts I've seen do it and call them out on it, you'll get a crappy valuation. Right? It's very easy to overvalue your company by assuming that companies grow at very high rates forever. Perpetuity, remember, perpetuity means forever. If that little g in the perpetuity formula is 5%, 10%, something crazy high like that, then your continuing value is going to explode. This is going to be such a massive number that your value per share will be massive, unrealistic. Now, that's how analysts get fired. Because inaccuracy can be both on the low end and on the high end, right? So it's important to not just ignore this perpetuity. Oh, it's just a perpetuity, just dividing two numbers. Yeah, you're dividing two numbers. That's correct. But that doesn't mean that you just, close your eyes and say, oh, 2%. Yeah, whatever. You have to think about, even as something like a perpetuity formula that is very easy and simple to calculate, you have to think about the inputs. Right? And the reason why you have to, it says right here, if continuing value is 50% of the value of the discounted cash flow value, then a 10% increase or change in the ending cash, no plat, which is an input in this perpetuity I'm about to show you, changes the valuation by 5%. So a small change in the final cash flow at the year 10, in this example, which example here, because this final cash flow number is used in the perpetuity. So if you artificially increase this number at year 2018 here, then your continuing value is going to explode as well. So everything has to be realistic is in this continuing value formula. This is what it looks like. Continuing value formula is a perpetuity. It's equal to the NOPLAT, which is that's that realistic number, at t plus 1. So for you guys, that would be 20, 30 something. Let's have a look. Where is it? KGW. So for you guys, that would be year 2034. Right, so all the action happens here. So notice, I think I've said this before in my first workshop. So the way KGW works is, you can think of it this way. You've got the historical data here. You should be working on that now. All that historical data comes in here. You forecast the cash flows in a detailed way for the first 5 years here. Then for the next 10 years, you just use KGW calls it phase 2. And after phase 2, there is this continuing value section. This is where you input your continuing value assumptions. Stuff like long-term growth or something like that. The G, see? The little G, long-term growth in perpetuity. Right? So let's talk about this formula. This is how it works. Again, it's a perpetuity, not complicated. NOPLAT at t plus 1, so 2034 for you guys. Multiplied by 1 minus G over RONIC. RONIC is not ROIC. RONIC is the marginal ROIC. So the ROIC that is likely to happen forever. Think of it that way. RONIC, the word is marginal ROIC, right? RONIC, yeah, on new investment, right? So if an investor was going to come in to invest in the company, what would the company be able to return? Not currently, but some in maturity, in perpetuity is the term used there. So not the current ROIC or something like that. What is the sustainable ROIC, if you like, is really what RONIC means. All divided by, in the denominator, is just WACC minus growth. Because analysts manipulate these numbers, and I hate it, absolutely hate it, especially the G, long-term growth on the company. Growth is not infinite. And the formula and the textbook as well recognizes this. It's not complicated to recognize that this is how analysts manipulate their valuation in the continuing value, because it's, the reason why they do that is nobody asks them about continuing value, and so far into the future, even if they're wrong, they won't be wrong for 15 years. So what the textbook and I agree with as well is the conservative thing, what you should be doing in your assignment as well with JB Hi-Fi, set RONIC equal to WACC in this equation, and that will collapse your continuing value formula to this, just NOPLAT divided by WACC. In other words, when you're in your KGW model here, in this section, you should select number 3. Have ROIC or RONIC, your new ROIC, if you like, set. So you have 3 choices. You can input a value of ROIC, of RONIC, sorry. That should really be RONIC, not ROIC. I'll change that. You can use the one from the last year, from 2034, or have it equal to WACC. Once you have it equal to WACC, you can leave this G blank. You don't need it anymore. So leave that blank, select number 3 here, and by selecting number 3 in your assignment, you're saying that RONIC is equal to WACC, and the continuing value formula should be that. And with a mature business like JB Hi-Fi, you should be doing that anyway. Like we talked about, and I showed you data on households and sales growth, they, in perpetuity, which means organic growth, not artificial, they cannot grow beyond some kind of a long-term growth in the economy or growth in the number of households. They are a mature business. JB Hi-Fi, it's a great business. I think it's a great business, good management as well, but they will not give you 20% growth. They will not grow at a very high rate in terms of the share price, in terms of the dividends, in terms of organic growth. Because of that, in steady state, the G will be tiny anyway. So this assumption also makes sense that long-term growth will be very, very small. So you don't need the G is what I'm trying to say. Right? The new investment, ROIC, is roughly going to be equal to the WACC over the long term in steady state. Right? And this formula then collapses into this. Do that. If you disagree with me, you can. And I'll still mark your assignment and not deduct marks, but please have a reason why you don't think that's the case. What's the magic sauce that JB Hi-Fi has that will allow it to grow above WACC? And don't say artificial growth, because that cannot be forecasted. Yeah. Of course, the company can buy other companies. They bought good guys. That's artificial growth. Artificial growth has nothing to do with continuing value. Nothing. Continuing value is a reflection of organic, sustainable, steady state growth. Acquisitions are not a steady state event. But if you're an analyst and you want to play games with the G, this is what it looks like. It's a great way to manipulate your valuation. If I was your boss, I would fire you, but this is what you can do with it. So imagine in this chart you have continuing value. We've got continuing value here on the y-axis. On the x-axis, we got this return on invested capital. Let's think of that as the ROIC. As you can see, when you start pumping up the G from 4% to 6%, from 6% to 8%, because it's a perpetuity, the growth is the increase is geometric, so it goes up to a very high number for the continuing value very quickly. Even a 1% or 0.5% growth has a significant impact. First of all, I've never heard of a company that can grow in perpetuity at 8%. It doesn't exist. It does not exist. Apple, it doesn't do that. Cochlear doesn't do that. eBay does not do that. Amazon does not do that. No company in the world does that. The East India Trading Company, which is the world's first company that had a global monopoly on trade, was not able to do that. If they cannot do that, if the East India Trading Company cannot do that, nobody can do that in a competitive environment. 8% growth is ridiculous. It is a fantasy. And I've seen analysts do that, put it at 8%. And I was just like, what are you doing? You have absolutely no clue. Where did you do your degree? Yeah, I don't know. Online, probably. Right? 8% growth forever, that's ridiculous. It's artificially way, way unrealistic. Right? Okay, so that's our continuing value formula for JB Hi-Fi. Please select option number 3 in KGW, and this is how the continuing value will be calculated. I think in my example, what did the Lecture 2 example team do? What do we got here? Lecture 2 example. Let's go. As you can see, continuing value is very high, 40% of the valuation, as you can see. If we go to the forecast drivers all the way to the very end, very wisely, this team chose option 3. So this, they could leave that blank, by the way. They didn't have to enter that in. As you can see, nothing changes. Even if you include it or don't include the G, nothing changes the continuing value. But if you change this to 1 or 2, say 2, it goes undefined because it's exactly equal, because this is blank. But let's say option number 1. And let's put in a value, let's say 15%, something crazy like that. Yeah, it starts going up quickly. 762, let's have a look. 762, let's go to 16%. Yeah, goes up, and then let's start playing games with the G. 3%, didn't change much. 4%, yeah, it goes up. 5%, and it goes up very quickly. And do not do that as an analyst. It's a very cheap, obvious way of you manipulating your valuation to get a high value per share. The reason why analysts do it in practice is they want a buy recommendation on the stock. Because a buy recommendation on the stock generates fees, trading fees. And there is a conflict of interest here. Analysts are not paid, they're paid by the bank, but not paid by the investors that they are advising. Yeah, the investors that read those equity research reports do not pay the analysts for them. the way the bank gets its money to pay the analyst is through trading. So you as an analyst, this is why analysts are biased towards the upside. They're more likely to have buy recommendation than sell recommendations, because the fact that they value the company, write their report and say buy, 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 the fact that report is free for the investor, because generally that investor, either a company or a wealthy individual, they have a relationship with the bank. Part of that package, that contract says you get all my research reports, equity research reports for free, and all the fees come from trading. So if you read this report, JB Hi-Fi analyst said buy the stock, the fact that you have access to that report and you read it is free. Where the bank makes its money is if you want to buy, because you have to call up the bank and say buy the stock. Or you can go behind the bank's back and get a Comstock account for $29 and buy it yourself, but if the bank finds out, they'll cut your service. And generally, these big institutional investors, the hedge funds, they don't buy 100 shares. They don't buy 1,000 shares. They buy millions of shares. When you start buying millions of shares, you cannot buy it using a Comstock account because of something known as trade impact. When you start trading in icebergs, icebergs are large share orders, so 1 million shares, 2 million shares, the price starts going up quickly. To make sure that the price doesn't go up quickly and you can trade the million shares, you can buy the million shares for a good price, you have to go to a bank and go to their, it's called equity sales or cash sales team, and they, because of their relationships, can get you those million shares at a fixed price or less and avoid trade impact. That's how banks, investment banks, the equity sales desk where I used to be, that's how they make their money. The sales traders, they're called, they have these relationships with people from other banks, large institutional investors, hedge funds, mutual funds, and they know that they have these large shares in this company, so they can go to them directly and, oh, do you want to sell 1 million shares? Let's negotiate a price. Think of them like brokers, right? So they can get you a better deal for these large iceberg orders. That's how the cash sales generate the desk. That floor in every bank generates most of this money through trading. The equity research analysts actually don't get paid for their reports, for their work, which is a shame. Which creates a conflict of interest, because they want the investor to trade, right? So they're more likely to sell buy, or more likely to say buy, because if they buy, you have to buy through the bank, and sell through the bank, right? So you get fees twice. Yeah. That's a different story. So let's complete this lecture. We're almost there. So after you have the continuing value, you have to consider these non-operating assets. Again, non-operating assets, you want to use market values. What are they? They're anything that is not included in the DCF valuation of operations, usually very small. We want to use market value for non-operating assets. Generally, it is not available. So sometimes, unfortunately, most of the time we have to use book value. But imagine that, and I think a few companies, not that we valued in this course, but some companies that I could choose in this class have stocks in other companies. So what all so if you know how much numbers, let's say BHP Billiton, a very large company here in Australia, has shares in JB Hi-Fi. They don't, but you assume they do. Well, if you wanted a market, that's a non-operating asset. A company holding shares in another company that is not in the same industry, that's a non-operating asset, obviously. They will recognize, BHP will recognize the book value of those shares on their balance sheet. The book value is not what we want to use. We want to use market value. Well, with shares that are listed, market value is very easy. All I have to do is, again, go to the ASX, look up the share price, the current market price for JB Hi-Fi, which BHP in this imaginary scenario is holding on its books, and just take the number of shares BHP is holding in JB Hi-Fi, multiply each one by 26.26, and I'll get my market value of a non-operating asset. Yeah. So if a company holds shares in another company and that other company is traded or listed, and you can look up its price, you can get market values very easily. That is rare. Usually the non-operating assets are DTA, For deferred tax assets, book value is actually pretty good because the tax office doesn't give you a return for the deferred tax assets, so no problem there. Unutilized factory or unutilized land, that generally doesn't have an active market, so book value is good enough. There's not buying and selling of land on a very frequent basis. You might think, oh, buying and selling of houses. Companies don't buy and sell houses, they buy and sell land and factories. Those transactions are not every day or every week. They happen once every, in Australia especially, such a small market, they happen maybe once every couple of weeks. And usually each land is different size, different location. There's no market for it, right? So you have to use book value. Question?
Even if a company has a bit of land and they deal in land, like buying and selling land, but their business model is like JB Hi-Fi's business model, is that income they earn from trading the land, will it be operating or?
It's an excellent, the question is brilliant. So it's a very, very good question. So the question is, what if, McDonald's is the best example there, what if the company is buying and selling land? It might not be their main business like JB Hi-Fi, main business is selling electronics, but they still do it, let's say, because they're considering opening locations, then they change their mind, sell the land. Would that be operating? If they did that on a large scale, the answer to that question is yes. The perfect example of that is McDonald's. McDonald's, people think it's a cheap, crappy food in a restaurant. That's true. That's their business of selling this garbage, which you should not eat. I'm watching you. Stay away from that. Healthy is important. But their most profitable business is not food. They actually make very little money on the food. That's why it's so cheap. Their margin is nothing, a couple of percent. Their business is twofold. Essentially, the franchisees paying them fees for using the brand name, their product, their recipes, their burgers, and their menu. And second is land. To keep control of the franchisees, McDonald's usually, when you want to open up a restaurant, will buy the land under you. And then you have to pay the franchise fee. They might contribute into creating the building and the golden arches. But if they own the land, McDonald's is essentially a landholding company. It is not a restaurant. And that is correct. McDonald's is not a food business. If you go onto any exchange, you'll say, oh, it's a food company, right? In a way, that's true. But the food is really an excuse. The main business of McDonald's is buying land and identifying profitable locations with a lot of foot traffic to open up a new restaurant. They buy that land, they might change their mind, the franchisee pulls out of the negotiation, whatever it is, and then they sell it. For a company like McDonald's, even though you think of it as a restaurant, buying and selling of the land, as the gentleman has asked, would be actually part of operations. It would not be a non-operating income or an investment. Correct. If you do it as the side business is quite large, then yes. But with JB Hi-Fi, because they open on average 5 stores and close 1 on average, and most of the openings are in shopping centers anyway, they cannot buy the location even if they wanted to. It would still be a non-operating asset because even if they buy some land and then change their mind or whatever it is, it would be maybe 1 a year, maybe 2, maybe 2 max. So that's just too infrequent to be considered as operating. But it's a very good question. It actually goes to the heart of what is McDonald's, because McDonald's is not a food company. It is a real estate company. Yeah, and people don't think that way. The food is actually just an excuse. And they make no money on the food, by the way. They make food on the franchise fee and on the real estate. Yeah, very interesting, McDonald's. It's a horrible, don't eat it, but as a business, it's fascinating. Yeah. So with non-operating assets, generally market value is not really available, so we have to use book. For JB Hi-Fi, if they have some DTA, I think they had some in the past, not anymore, so that would be 0. Excess cash is a non-operating asset. If they have any excess cash, if 2% of revenue is more than the cash they have in 2018, then all the cash is operating, so no excess cash, 0 excess cash is non-operating, so no issue there. But if 2% of revenue is less, than the cash they have on their balance sheet in 2018, then you have to split the cash into operating, 2% of revenue, and the rest is excess cash, which is a non-operating asset. So the book value, so the non-operating assets with JB Hi-Fi, most companies will be quite small, but I'm happy for you in the assignment just to use the book value for that. That's good enough. Not the best. You want to use market value, but generally there's no market for these values, so you don't have market values. The debt, not too bad. The debt is not too bad. So we've got two things. One thing that we cannot forget: the company doesn't have any minority interests, so no problem there. Company doesn't have any high. It does have options. I think I'll talk about that in workshop 6. Not this week, next week. They do have some options. Employee options, actually. They don't have any warrants or convertibles. No preference shares. Bingo, bingo. They have operating leases. They have to be capitalized, like I said in the class or the workshop last week, and treated as debt, so they have to be subtracted, and of course they have debt. So for JB Hi-Fi, debt, capitalized operating leases, and these executive options are of interest to us. They have to be identified and subtracted. They are our non-equity claims for the company. And everything else is just value attributable to shareholders, and that's what we need. That value is what we need to divide by the number of shares. Yeah. So last slide. Any questions on that? Yep.
Just for the workshop, the week before you say that the year for leases are 7, but last week is 5.
It's not 5. 5 is too small. It's either 6 or 7. I think I remember saying 6. Let's have a look. 6? Then use 6. If I said 7, then I must have been talking about the percentage, the lease rate. And that is, again, a guess as well. If you don't want to use 7, you want to use something less, like 6, that's also fine. 7 is just, I've got a friend in Westfield, I know how much, he told me how much he gets charged, which is ridiculous. And that it results in a rental yield of about 7%. That's why I came with the number. That's how I came up with the number. So, in Sydney probably more, in Perth would be probably less, but on average 6, 7 sounds about right. But for the lease period, the life of the lease, they have leases that are less than a year. Then they give you how many leases they have between 1 and 5, and then more than 5. And there are a lot of them are between 1 and 5. And the reason why I chose 6 and not 5 is the leases that come after 5 are more than the leases that come before 1 year or less. So 6 sort of looked right. It's a guess, but 6 is in the workshop, so use that. To answer your question. Any other questions? Okay, last slide. Let's have a look here. It's good because I'm starting to lose my voice. So let's talk about this mid-year adjustment factor. So you notice, annoyingly, you've got this number here. What is going on here? What is this? It's called the mid-year adjustment factor. What is this? What is this business? In your KGW model, for my lecture 2 example, the mid-year adjustment factor was 1.073. What is that? It's a timing adjustment. That's what it is. So here's the idea behind it without looking at the slide. This is the idea. So the idea is that we have this company, JB Hi-Fi. We're here, time 0, time 1, time 2, time 3, time 4, all the way to infinity, right? Now what we're saying is all the cash flows, the first cash flows that we're discounting to time 0 happen here. All the cash flows the year after happen here. All the cash flows after that occur here. That is incorrect. The company does not sell all the TVs and fridges at the end of the financial year. We just have to assume that to make the calculations easier. In practice, the company does selling and buying of TVs, fridges, it pays its salaries to staff continuously throughout the year. Right? Every day, JB Hi-Fi is selling TVs, fridges, stereos, DVDs, whatever, online and in its stores. But we assume all these selling And the expenses that selling generates from rent and paying your staff happens at one point in time at the very end. And we discount these cash flows here, let's say in September, October, we discount them as if they occurred here. These cash flows, let's say in December, Christmas time, when sales are very high in electronics, we assume that they happen here at the end of the year. Here in February, January, or whatever it is, all these sales and expenses occur again here at the end. In other words, we're over discounting from a time value perspective. We should be discounting here, we should be discounting the August numbers on a monthly basis, or even ideally on a daily basis. That is unrealistic to do in a discounted cash flow model. The most frequent model I've seen is quarterly in practice. There's no such thing as a monthly cash flow. First of all, you don't have any data on a monthly. Companies do not report monthly results. If they did, you theoretically could have a cash flows for January, cash flows for February, March, and discounting everything to time zero at the monthly rate. That's true. Companies most frequently produce their results on a quarterly basis in the US. JB Hi-Fi is not a US company, it is an Australian company. By law, it produces its performance, its income statement or balance sheet on a semi-annual basis. So yes, you can have a KGW model that has the timeline sliced into 6-month increments. That's true, you can. Don't do it. KGW does not allow you to do that anyway. It is an annual model. And but it doesn't ignore the fact that it's over discounting these cash flows. What it does, it corrects for that over discounting by using something known as the mid-year adjustment factor. All right, so going back to the slide, the model knows that its cash flows are not annual, so it scales up the present value of operations, it increases the value of the operations it adjusts for the over discounting by multiplying or scaling up, whatever you want to call it, the present value of operations by this mid-year adjustment factor. And this is what's used to correct the over discounting. Sometimes it can be tricky, not in our case, but it says there as cash flows accrues, the value of all claims will vary. That's true. You might have, or you might be like, if you just use one number, and a company like JB Hi-Fi has a lot of revenue in December, obviously, because of Christmas, you should be using more than one number. That's true. Yes, there's a lot of cash flows that happen in November and December and January for a retailer. So using one number, this mid-year adjustment factor, is not accurate. Yeah, I get that criticism, that's true. But to have multiple factors or more correction in December, it just gets too messy. So we as analysts don't do it, but there is a valid point that if a company does 50% of its business in November, December, and January, then maybe you should have some kind of a second mid-year adjustment factor. Yeah, KGW does not allow for that, but the argument's there. Don't do it. It's not worth it. So as you progress through the year, cash flows may be applied to reduce debt. That's also another thing that could happen, right? The company doesn't have to just sit on the cash. It can use it to reduce its debt and reduce its interest expense. That's true. They can. Again, they will never tell us to what extent. Value of enterprise value and equity rises as cash flows accrues and future cash flows nears, hence increasing NPV. Yeah, again, that's, the mid-year adjustment factor is not perfect. It assumes that the cash flows are on average equal throughout the year. Yeah. So, but we cannot just overthink it. We need a practical solution to this over discounting problem. So that's where the mid-year adjustment factor comes in. Use the latest balancing date or the reporting date, the last company report date, which is 30th of June for JB Hi-Fi, and deduct this time, compare that time, the last company year-end for the company, to when you do your valuation. All right? So practically, how does that look like? Well, what you do is you adjust for each month that you're into the current financial year. In other words, the mid-year adjustment factor is equal to 1 plus the WACC to the power of 6 plus X divided by 12. What's this X is your question? The X is equal to the number of months since the end of the financial year. So now we're in August, coming towards the end of August. So what do we've got? We've got 1 month, right? So no, 2 months. Sorry. So the financial year ended in June, end of June. So we had April and August. So we have 2 months into the new financial year. X should be 2. The model does, i.e. the difference in months between the financial year end and the valuation date. Valuation date is when you sort of submit your assignment, which is in September. So you don't have to, KGW gives it on a monthly basis. You don't have to go to the daily level. Sort of end of August is sort of close enough. So what did I do for you guys? I already did this for you. So this is where you input that adjustment for the mid-year calculation. That's why you want to enter these. This is the example. This is the KGW model, the blank one. Yes. So up here in the forecast drivers tab, you've got all these dates. Notice